Lastly, let's look at some types of ratios that you will need to see on the exam to learn to memorize that have to do with the statement of cash flows. It's also a great check-in, right? Because formulas and ratios are important, not only for this test, but also for audit and BEC. If you overstudy them for this exam, it's really not a problem because you'll see them again and get mutual benefit out of them, right? There are certain things in this exam where if you overstudy them, you'll never see them again, and it is what it is, right? But these don't feel like you're wasting your time if you're taking too much time to memorize them. Let's run through here and see why these are important. Well, as an investor, I might want to see a liquidity ratio. How liquid is the company? Can they pay down their short-term debt and the maturing obligations as they become due? Well, how do we determine that? Through the current ratio and the quick assets ratio, we can determine, do you have enough current assets to pay down your debt, right? So your debt is usually long-term debt, and then it becomes short-term as it comes closer to being due. And can you pay that down, right? Can you pay down your current liabilities with your current assets? What about activity ratios? So activity ratios are going to tell me as an investor or a creditor how effective the company is at using its assets that it has, right? So receivables turnover and inventory turnover, are you being efficient with your receivables and collecting them, right? You don't want to just see your receivables sitting around because receivables are great, but the cash is even better, right? You want to see the cash from the customers who owe you the money. Too many companies just don't collect on their receivables and they never see the cash that is owed to them. And then inventory turnover, sure, awesome. Maybe you have a lot of TVs if you're an electronics company, but at the end of the day, we don't want those TVs. We want the cash people will pay for those TVs. So are you being efficient with selling those TVs? What about profitability ratios? Everyone loves profitability. Everyone loves to see a company making money. Well, this is going to measure the degree of success or failure for a given period. So in the year, is your earnings per share pretty solid? Like, are you making a lot of money per share for the investors? What about the rate of return on assets? Are you making money based on the assets you have, or are they sitting around and being useless and just gaining dust on them? All right, lastly, coverage ratio. These are going to measure the degree of protection for long-term creditors and investors, meaning, is this a trustworthy company financially, debt-wise? Do I want to lend money to them? Well, you can determine that based on the debt to total assets ratio. If they have a crazy amount of debt, I mean, maybe they shouldn't be taking on more debt. They should be paying down their debt, right? I mean, I'm not going to lend someone an insane amount of money if they just can't even pay down the debt they have already. And then times interest earned, that is another formula, because are you paying out just a crazy amount of interest expense, right? Like that's not a value add. Paying out interest expense is not a direct value add. I don't want to see a company I'm investing in or lending to paying out a crazy amount of interest expense. Those are our ratios. Be familiar with them, practice them, and you'll do super well.